So I was at the gas station 2 weeks ago and gallon was 310. Filled up, didn't think twice. Yesterday I went back to the same station and gallon was 358. That's 15% increase in just 2 weeks. And look, I get it. Prices go up. That happens. But what bothered me was this. When I checked the oil market, actual price of oil, it had barely moved. So I started asking, where did the 15% go? And the answer I found is something I generally think most people don't understand, including most of financial journalists. There are actually two prices of oil, and the one you see in the news, that's not the real one. We are going to get into exactly what that means and why it's matter for your wealth. Okay, let me start with something that sounds simple, but is actually kind of wild. Oil has two prices. This is what comes up when you Google oil price right now. This is chart from Yahoo Finance and is around 110. This is called Brent futures. Is the price you will see. You will see on Bloomberg or in CNBC in every headline. But here is the thing. The price is a promise of oil. It's a contract, a paper. Now let me show you the other price. This is called dated Brent. This is what is actually cost to buy a physical barrel of oil. Loaded onto real ship, delivered to real refinery. And right now that the price is 132, sometimes 144 on peak days. The Wall Street Journal called this gap, and I'm quoting here, historic. The CEO of Black Gold Investments said, and I quote, "Never has the market seen an oil market disruption of this size. That's a $35 difference between what the news tell you oil costs and what it actually costs." And to put it in the perspective, for almost 20 years, these two prices moved basically together, maybe $1 or two apart, maybe five in a real crisis. Right now it's 35. And analyst from Dynamics Corporation told CNBC, and this is one of the clearest explanation I've seen. Dated Brent and 144 isn't just a price record. It's the physical market telling you the real barrels are becoming scarce. The market is pricing in scarcely, not just risk. Back during COVID, we also had massive gap between paper and physical oil, but in other direction. Nobody wanted oil. Demand collapsed. Today is exact opposite. Everyone needs it, but nobody can get it. That's a supply emergency. Okay, so let's talk about how big this actually is, because I think the most people, including me until recently, don't fully grasp the scale. The world used about 100 million barrels of oil every single day, and look at what oil actually powers. It's not just gasoline, it's how food gets to your grocery store, and it's fertilizer that grows that food. It's every flight, every cargo, every ship, it's every hospital generator. Oil in the nervous system of the entire global economy. So when the Strait of Hormuz, a narrow strip of water that 20% of the world oil passed through, get effectively closed, what happens? At first, nothing. Because countries have reserves, because there are tankers already in sea with oil in them. The system has a buffer, and the buffer has been buying some time. But here is what the buffer actually looks like. Country by country, you can see the wave of impact moving from the east to west. Asia got the first, then Africa, then Europe, and according to JP Morgan, the United States was last. Our buffer ran out around April 20, which, depending on when you watching this, was either just few days ago or is right now. I want to show you how it actually looks like on the ground, because there are stories happening right now. The most Americans and European media outlets are barely covering. The Philippines, a country that imports 98% of the oil from the Middle East. In March, their president signed an executive order declaring a national energy emergency. Not an energy concern, not an energy warning, it's emergency. Diesel price in Manila went from 54 pesos to 76 pesos. Basically overnight. The government said they had 45 days of diesel left. 45 days of diesel. You understand it? 25 days of cooking gas. Transport worker went on strike. Government office switched a 4-day work week. And Thailand? The country has a $7 billion fishing industry. Half the fishing fleet is already docked. Because the cost of marine diesel went so up that so much going on the sea means lose money. The National Fisheries Association is warning that without government intervention, the rest will follow. India, 330 million households use LPG for cooking. That's more than the entire population of the United States. And 60% of the gas comes straight off Hormuz. Observer Research Foundation, one of India's top think tanks, put it simply, 60% of India LPG demand is imported, and 90% of those imports go through Hormuz. The government had to suspend commercial LPG completely, just to make sure there was enough left for household cooking. And in Tamil Nadu alone, just one Indian state, 10,000 restaurants were facing shutdown because they couldn't get cooking gas. Thai magazine ran a piece covering of global wave of rationing. Thailand, Vietnam, Indonesia, all telling government works from home. Not to fight COVID, to save fuel. And here is the thing. All of this happening while most of people in the US and Europe are still feeling up, going to work, buying accessories and assembling this someone else's problem. It's not someone else's problem. We are just last in line. And if you want to see what last in line actually means when it arrives, look at Africa. Zimbabwe is literally diluting its petrol. They increase an ethanol content from 5 to 20%, just to stretch what they have to left. South Sudan, which generates 96% of its electricity from oil, started rationing power in the capitals. And electrical engineers there told the BBC that power goes from 4 p.m. and doesn't come back until 5 a.m. This paralyzed most of businesses, he said. And Atlantic Council, Washington-based think tank, pointed out something that I think get overlooked. 30% of global fertilizer trade goes through Strait of Hormuz, which means this isn't just a fuel crisis. It's starting to become food crisis. So where does the US fit into all of this? This is the global supply network. The red dot is Strait of Hormuz, and these blue lines are roads that used to carry 20% of the world's oil. They are effectively shut. The orange dashes line is alternative. around the Cape of Good Hope. It adds weeks to every delivery and costs significantly more. JP Morgan published a report that had three numbers that I haven't been able to stop thinking about. 1. Physical oil hit $144 before settling at 132 versus 102 on paper. 2. 426 tankers are currently stranded. And 3. If the strait stays closed into July, JP Morgan says Brent hits 120, and that's their base case. And their upside risk scenario is 150 per barrel, which would be the most expensive oil in history in nominal terms. Now, here's the specific timeline the JP Morgan laid out. The last tanker that cleared the straits before the close left February 28. It was expected to reach its final destination around April 20. That's the moment when, according to JP Morgan's, pre-closure barrels are fully used up from the global supply chain. After the date, the buffer is gone. So if all of this is true, if supplies are running out, if 426 tankers are stranded, if physical oil is $132, why does the news still say oil is $100? Why haven't price exploded yet? This is the part that I think is the most important and the most underreported. Let me explain how oil futures works. The futures contract is basically a promise. Someone promised to deliver oil and set price to future date. Under normal circumstances, the paper price is physical price, stay close together because this promise reflects reality. But what happens when someone sells a massive amount of these promises, promising to deliver oil at $100 a barrel without actually owning any oil? That's called a short position. And theory shared by a growing number of market analysts is that someone or some entity has been doing exactly this, selling enormous quantities of paper oil at 97, 100, 102 a barrel. And the market reacts, that's someone big thinks oil worth $100, everything is fine. But the physical reality disagree, because real refineries trying to buy real oil and paying 132, 144, and that's a $35 gap between the promise and the reality. That's the biggest gap ever in history. And here where it gets serious. When this futures contract expire, when the buyer says, okay, where is my oil? The seller has to either deliver physical oil or buy back the contract, whatever the current market price is. If physical oil is 132, at the moment they have to pay it, all of them, at once. This is called a short squeeze, and it can cause paper price to catch up to the physical price very, very fast. Morgan Stanley Commodity Strategies explain the mechanism like this, and I think is the clearest version I've read. Dated Brent is the market's assessment of what a physical barrel is worth right now. IC Brent futures is a standardized financial contract. These two prices are connected, but they do not measure the same thing. And the translation, the paper price can stay artificially low for a while, but at some point you cannot print physical atoms. And when these contracts come due, physical reality wins. Now I want to zoom out, because this isn't just first oil crisis in history. And history has some very specific things to tell us about what comes next. This is a comparison of three major supply shocks of the last 50 years: 1973, 1990, and right now. Look at the numbers. 1973, the Arab oil embargo, 7% of global supply went offline. The result? Oil prices went up 300%. The stock market fell 52% over 23 months. It took 7 years to fully recover. Inflation hit 12%. In 1990, the Gulf War, also 7% of light oil up 75%, stock down 21%. But the war ended quickly, supply came back and stock recovered in 4 months. Today, between 50 and 20% of global supply is offline. This is more than double either previous crisis. Physically, is up over 200% from pre-war level, and the stock market is all-time high. And I want to show you something specific about 1973 because I think it's the most relevant piece of history right now. See the green dot line? That's October 22, 1973. The ceasefire was announced when the Arab-Israeli was over, and the S&P 500 went up 2.3%. That's the day. People through the worst was behind them. Then it fell another 40%. The market stayed calm for weeks and after ceasefire because nothing recent history prepared investors for oil prices going 300 in 6 months. There was no model for it. By the time reality pieces stock up had already lost half of their value. We just had ceasefire too. Markets rallied. Sounds familiar? Okay, bear with me. One more section. Because this one doesn't make headlines. But I genuinely think this is the most important piece of the puzzle. This chart shows a 10 years government bond yield for 5 major economies since February 28, the day the war started. Bond yield is basically the interest rate a government pays to borrow money. When it goes up, borrowing gets more expensive. Look at these lines. US up, UK up, Germany up, Japan up, and there's the China line is going down. The 10 years US Treasury yield hit 4.4%. China 10 years bond 1.83, and it's been stable or declining the whole time. People's Daily, which is essentially the Chinese government's mouthpiece. So take that for what is it. Reported the foreign capital is flowing into Chinese bonds precisely because they are seen as stable. Reuters reported that Chinese bond markets drew 2.5 billion of foreign inflows in March, while other markets were selling off. Louis Liu from Aberdeen Investment called it cute, a safe haven in the current environment. Now here is why it's matter for you specifically, even if you are never heard about Chinese bond in your life. The US 10 years yield is in the interest rate that everything in the American economy is priced off debt. Mortgages, car loans, business loans, credit cards. When the yields goes up, and right now is it 4.3 and climbing, all of this get more expensive, and oil shock that driver inflation higher makes it harder for the Fed to cut rates, which means yields stay high, which means your mortgage stay expensive, and the cycle feeds on itself. And one more thing, because oil just an oil. This is the price of urea, the most commonly used fertilizer in the world. See that spikes on the left, that was 2022. The Ukraine war disrupted natural gas supplies. And urea is made from natural gas. Food prices follow about 6 months later. That price spike caused political crises across the developing world. Now, look at what's happening on the right side of the charts. We are doing against Euro is currently at 695 a ton, up over 60% from years ago, and the Strait of Hormuz, which is now closed, carries the one things of global fertilized trade. Wikipedia summary of 2026 Iran war fuel crisis puts it simply. Euro prices have increased 50% since of the start of the war. The UN had to specifically negotiate with Iran and allow fertilizer shipment through the strait because world food production was at risk. The 6-month lag means we will fill this grocery store around third quarter, fourth quarter of this year, not at the pump. There, bread, corn, rice, anything that grows in the field and need fertilizer. So let me pull this all together. There are 3 waves coming. We have already here gas prices, fuel surcharging, airline tickets. We are feeling this now. We have 2 hits about 6 months grocery store prices because fertilizer prices are already up 60%. Depends on the Fed. If oil keep driving inflation, they can't cut rates, which means mortgages, business loans, and all of this stay expensive. Now I want to be honest with you about something. I could be wrong about the timing. A real case fire could happen this week. The strait could reopen, prices could normalize. I generally hope that isn't the case. But here is what I can explain away. The physical oil market is telling one story, the paper market is telling a completely different one. The fertilizer prices are telling one story. The bond market is telling one story. And the 50 years history says that the paper market and the physical world disagree. It is always the physical world that wins. The question isn't the whether, it's when. If you want to see how I'm personally thinking about positioning for this, I will have you a follow-up video up next week. Drop a comment below telling me what you are seeing, where you are gas prices up in your city, your country, and what are you noticing. And if this was useful, you know what to do.